In March 2023, Silicon Valley Bank collapsed in 48 hours, not gradually, not with any warning signs we could see coming. In just 2 days, $8 billion in deposits vanished, and over 1,600 companies lost access to their entire operating capital. But here's what makes this suspicious. The Federal Reserve and FDIC had been monitoring SVB's deteriorating situation for months. They watched the internal stress tests. They reviewed the bond portfolio that was hemorrhaging value. They knew exactly what was coming, and yet somehow they let it collapse anyway. What's even more disturbing is that when it did collapse, they broke their own rules to bail it out, protecting wealthy venture capitalists while everyday people lost their life savings. We're not being told the full story about why the biggest financial disaster since 2008 was allowed to happen under their watch, and more importantly, who benefited from letting it burn. That's what we're uncovering today. Silicon Valley Bank wasn't a random failure. It was a controlled demolition that regulators saw coming and did nothing about. Let's talk about what the data actually shows us. In Q4 2022, SVB held $91.3 billion in deposits. By March 8, 2023, depositors had withdrawn $42 billion in a single week. That's not normal market behavior. That's panic. That's institutional death. And here's the question we need to ask ourselves. Who caused that panic? Was it the market? Was it natural economic forces? No. The answer is hidden in plain sight. It was the regulatory system itself that created the conditions for this specific failure at this specific time. The Federal Reserve's aggressive interest rate hikes throughout 2022, 11 consecutive rate increases, made SVB's bond portfolio toxic overnight. They held $91 billion in securities that lost value as rates climbed. But here's what's crucial. The Fed didn't just know this was happening, they orchestrated it. The stress tests they ran showed exactly which banks were vulnerable. The FDIC was monitoring their compliance reports monthly. The Office of the Comptroller of the Currency had full access to SVB's books. Yet somehow, right up until the collapse, regulators maintained SVB's well-capitalized status. The bank appeared safe on paper because the agencies controlling that paper weren't forcing them to mark their losses accurately. We were being protected by a system that was actively hiding the problem from us. And when you understand this, you start to see a pattern. This wasn't negligence, this was strategic. When the collapse happened, SVB's executives didn't just fail, they had already cashed out. CEO Greg Becker and his management team received $1.5 million in bonuses in early 2023, just weeks before the bank imploded. Not just salary, not just stock options, cash bonuses, paid out right before they knew the ship was sinking. That's not incompetence, that's foresight. That's someone who knows what's coming. The data shows something darker. SVB's leadership had been redirecting risk for years. They accumulated $91.3 billion in long-duration bonds during a period when everyone in finance knew interest rates were going to rise. And I mean everyone. The Fed had signaled this clearly. The bond market was pricing this in. Yet, SVB loaded up anyway. Not because they were stupid, but because the short-term strategy of accumulating bonds for profit made sense before they had to mark losses. Think about the incentive structure here. Executive bonuses are tied to short-term earnings, not long-term stability. Long-term stability is someone else's problem. So SVB's leadership maximized their 2022 earnings knowing that 2023 would be catastrophic. They were racing against a clock they could see, and they got their money out in time. Meanwhile, 1,636 companies, many of them startups with their entire operating capital at SVB, lost access to their funds overnight. Payroll couldn't be met, operations ground to a halt. Employees were laid off because the money to pay them was frozen. All because the regulatory system allowed a bank to gamble with the entire startup ecosystem and executives to profit while it burned. And here's where the data gets really interesting. When SVB collapsed, the Federal Reserve had a choice: either let it fail and destroy the entire venture capital ecosystem, or bail it out in a way that violated their own stated policies. They chose the bailout. The FDIC protected every single deposit, not just the $250,000 limit they're supposed to cover. That's $8 billion in taxpayer money being redirected to protect venture capitalists and tech executives. Startup founders who put their entire company's operating budget in SVB, protected. Workers who had their paychecks delayed, left to suffer. Banks that compete with SVB, not protected. But here's what we need to understand. They didn't do this because they're incompetent. They did it because they knew that letting SVB fail would expose a larger truth. SVB's problem wasn't unique, it was systemic. Other regional banks had similar exposure to bonds that had lost value. First Republic Bank, Signature Bank, and dozens of others were sitting on the same time bomb. Pacific Western, Umpqua Holdings, Western Alliance, all showing signs of stress. If they let SVB fail through normal FDIC processes, we would have found out that the entire banking system was built on accounting tricks and regulatory blindness. Depositors would have panicked, trust would have evaporated. So instead, they chose to protect the banks at our expense. They chose to move fast, so fast that Congress didn't even have time to properly authorize it. They invoked emergency powers. They broke their own rules. The message was crystalline. If we're big enough and connected enough, we're too big to fail. If we're not, we're exposed to the system's failure. The truly terrifying part is that this wasn't random. Look at the timeline carefully. The Federal Reserve raised interest rates 11 times between March 2022 and March 2023. They knew this would crush banks holding long-term bonds. The FDIC ran stress tests that showed exactly which banks were vulnerable. The Fed's own financial stability reports identified the risk, and yet they let it happen anyway. Why? Because the system requires collapse. It requires periodic destruction to reset and redistribute wealth. SVB's collapse wasn't a failure of the system. It was the system working as designed. It crushed smaller investors, protected large institutional ones, and transferred risk from private hands to public balance sheets. Since the 2023 collapse, regional banks have been consolidating into the hands of larger institutions. JP Morgan Chase, Bank of America, and Wells Fargo have absorbed the assets. The fragmentation that made banking competitive is being eliminated, and we're moving toward a more centralized system. That's not coincidence. That's strategy. That's the entire point. Silicon Valley Bank didn't fail because of bad luck. It failed because regulators knew it would fail, and they let it happen anyway because the collapse served a larger purpose. They needed to consolidate banking power. They needed to show depositors that their only safety was in the biggest banks. They needed to prove that the system protects the wealthy while leaving us exposed. The data shows us that government agencies had months of warning. They had stress tests, they had compliance reports, they had the tools to prevent the collapse. But instead, they watched it happen and then broke their own rules to bail out the people who saw it coming. The question we need to answer isn't, how did this happen? We know how. The question is, knowing what we know about how the system works, what happens the next time a bank gets shaky? Will we be protected, or will we be exposed again while the wealthy are saved at our expense? Comment below with what you think comes next for us, because if history repeats, they're already planning the next one.